The Fed kicking off another one of its two-day policy meetings tomorrow, widely expected to hold rates at current levels. Join us now with more on what to expect. Former Federal Reserve Vice Chairman and CNBC contributor Roger Ferguson. I think we get a lot of news, Roger, since last time you were on. I was trying to think of all the things that have happened that could inform your opinion and maybe the Fed's opinion. And so here's a couple of them. $91 oil. I don't know whether that makes the Fed more hawkish or more dovish. I could argue either case, because it's certainly a global tax, which you would think would help the Fed if it's trying to slow the economy down to some extent. You had the ECB raise rates, but say that's probably it. And you had a couple of inflation numbers that were, I guess, I wouldn't call them friendly, but they weren't just horrific. So that has caused some people, Roger, to say no increase this time, and maybe we've seen the last increase. Are you there yet?
I'm not there yet. You're right to say there's been a great deal of data. I think roughly the way you described it is right. One little nuance I'd make is the core inflation number ticked up on a month-over-month basis for the two readings we saw, which I think will raise a few eyebrows. So where I am is I think there's likely to be a pause here, but a clear possibility that the November meeting is, as they say, a live meeting. I don't think they're ready to say we are now done, and partly because some of the factors you talk about, such as oil creeping up, shows that while there are, a slowing in general, there still could be some things that drive inflation pressures in the wrong direction. So I think this meeting is a pause, but with the possibility of one more rate hike. And they'll tell us, because they're also going to release their summary of economic projections. So we'll see if they're thinking as well.
Has China, has China bottomed, do you think, Roger? And I'm thinking about oil and how that's going to impact the Fed, because it definitely does filter through to everything we do, you would think. And it's inflationary. But then again, with China weak, maybe bouncing, and oil, they buy in petrodollars too, I think. So, it's expensive there as well. So those things could be deflationary or inflationary.
Well, you're right to talk about the double-edged sword of things such as China potentially slowing. I emphasize potentially because, they are going to be working pretty hard to keep their economy on track. They have fewer tools than we do in the U.S., and so I think the reason the Fed is being, quote, data dependent, and as Powell said in his speech at Jackson Hole, will proceed cautiously, is because the incoming data is not all pointing in one direction. As he said in his speech, there's a disinflationary process underway, but inflation is still, clearly above the 2% target. Labor markets, which they've been focused on, absolutely softening, but we still see, as you've been reporting, a lot of restiveness, so we call it, in the labor market. So I think this is the time for the Fed to proceed very cautiously, and in no way should they say we are completely done, because I don't think they really know that just yet, and I think they want to have the flexibility to do one more if need be.
But, Roger, just one more? I mean, because most of the market commentators we speak with around this say that, okay, it's basically the same thing. Either they're done or another 25 basis points. That's not going to tip the scale too much.
I think that's part of the story here, but because indeed, I've seen a few economists that are even talking about a couple more. I don't think the data, I think the data are really showing that they're getting the kinds of impact that they want, but yet, as we've seen, there can be some upside surprises. So that's why I'm thinking a pause here, open to another 25 basis points. And as you point out, Becky, the probability that 25 basis points is going to tilt us dramatically one way or the other is not great. But given the fact they started late, I think they also want to be careful not to stop too early. And so I think that's another thing that's factoring into all of this.
We have seen some meetings in the past where the Fed chair seems to, not saying he tries to satisfy all people at the same time, but when he doesn't hike, sometimes he's hawkish. When he does hike, sometimes he seems to be dovish. He kind of like tempers things. I saw one headline in one of the financial websites that said, Jay Powell doesn't have to hike rates this time to derail the tech stocks, which means I guess they're expecting him to still be somewhat hawkish. Do you expect that in his commentary?
Actually, I do. I think what I expect the pause, but as I said a couple of times, I expect him to be clear that they are not done, still data dependent. I think he'll point out places where they want to see more progress and clearly leave open the possibility of one more hike in November. I think it
recession,
may sound if one.
Sorry, Rob.
I'm sorry.
I was just saying recession next year, first half of the year, second half, no recession, slowdown, labor weakness. Does it ever come?
I think we're certainly going to see continuing slowing, and I think whether there's going to be a recession has become more of a close call. Those that are expecting a recession are pointing to the fact that consumers are weakening as well, and that we don't know yet the full impact of the dramatic hiking that's gone thus far. So I would say recession still possibly on the table, though the odds have decreased. Slower growth certainly on the table, and let's hope, fingers crossed, that in fact the elusive soft landing does actually occur, but not a done deal yet on any of those points.